3, 2, 1. Welcome to the show.
Okay, it is June. Wow.
It is June.
Yeah. Summertime.
It's warm here today.
Yeah.
I might get a little time in the pool.
Got a little sunburnt yesterday.
Yeah. It's like good Irish blood, man.
Yeah, right?
Stay burnt all summer.
All right, man.
What you got?
It is a crazy market out there. I feel for people that don't have a plan. That's all I can say about that. Wow. All right. What we're going to take a look at this week is what I think, for me anyway, what I'm looking at are the 5 most important charts that I'm following. And I basically use it for context. I follow a lot of things, but these are probably the 5 most important charts that I'm following right now. So the S&P 500, obviously. RSP is the equal-weighted S&P, and we'll talk about that. TNX is the 10-year yield, so it's the yield on the 10-year bond. DXY is the U.S. dollar index, and HYG divided by IEF. It's basically smart money. So HYG is high-yield growth. It's a bond that, so when things are riskier, people buy high-yield bonds, meaning bonds and companies that are more risky than treasury bonds, for example. And then IEF is a 7 to 10 year treasury, so it's basically cash. So if you divide high yield growth divided by cash, you basically get a risk profile. So when high yield growth versus cash goes up, it's risk on, like people are buying risky stuff. When high yield growth versus cash is declining, it means people are pulling back from buying risky stuff. So they call it risk off. And they call that kind of a smart money chart. And then we'll take a look at the NASDAQ 100 because it's been exploding with the AI boom. We don't really have access to it in TSP, but you get you get some of its benefit from the C fund. And strangely, right now, we are not getting the benefit of it from the S fund, which is concerning. And then the weekly TSP charts. All right. So a lot of people ask S&P 500. You can get. So this is basically 3 different ticker symbols, and there's actually more than that. But $SP. It depends on the whether you're using Yahoo Finance or stock charts or TradingView or whatever. $SPX can be the S&P 500 index. SPX can also be it, and SPY is the easiest one to get. SPY is the ETF that tracks the S&P 500 index. So it's just like the C fund, where our fund is basically, it's not an ETF, but it's the same idea. And so when you punch in SPY, they move the decimal point one place. So if the index is 4,200, SPY is 420. So it gets a little bit confusing, but those are basically the 3 best ticker symbols to put into whatever website or platform, whatever you're looking at. So S&P 500, we're going to go into it a little bit deeper in the TSP fund charts because it's the C fund, and obviously for us the C fund is the foundation. So a couple of things I just want to do for a takeaway from here. It's pretty clear this is the 20-week moving average line. Okay, going back to the bottom here from COVID. Pretty clear by looking at the chart, when price is above that 20-week moving average line, you want to be in the stock funds. I mean, it's clear as can be, coming off of a serious low here in COVID, right? And then we had the biggest bear market we've had in a while, and we had a couple of overshoots above that 20-week moving average line. But for the most part, when it's below that line, you don't want to be in the stock funds, right? And now we're at a point where we got a really, really weak recovery. I mean, we had a pretty good move off that October bottom, and we've basically been flat ever since like November. So yes, we're having a recovery. It's a pretty weak one, but in terms of the price, once we get back above that 20-week moving average line, RSI gets above 50, MACD turns positive, you're in good shape. And so far, this was a question mark, and we're going to kind of look at that. And in a little bit, but it didn't really turn negative there. So really, this buy trigger is still in place. And if you, on a weekly basis, if you had gotten into the C fund back here when it crossed above 50, MACD turned positive, and you were above the 20-week moving average line, you'd have got the majority of the gains, all the gains in 23, and some of the last quarter in 22. All right. So really totally switching gears, equal weight S&P, okay? RSP is the ticker symbol. So equal weighted S&P is, imagine if you got the 500 biggest companies in the U.S. The regular index gives more weight to the higher capitalization companies. So that's why Microsoft and now I don't know if Nvidia's in the S&P, but Microsoft, Google, Apple, the big mega cap tech stocks have been doing really well, and they get more weight in the S&P 500 index because it's a weighted index. So the S&P moves higher. If you look at an S&P 500 equal weight, so if you don't give extra points basically for the mega cap stocks, they still get credit because they're big and stuff, but they don't get extra credit, right? This is what that chart looks like. So from the bottom in COVID, just like the regular S&P, market rallies, we get above it, stay above it, you want it to be in the stock funds until the same week, right? So what it's saying is basically the equal weighted and the cap weighted were moving together. So all the stocks in the S&P 500 are moving higher. And then they're all moving lower, right? They all hit the October bottom at the same time. Since then, we had a relatively similar ABC in the equal weight, and then it fell off the cliff. And it can't get above that 20-week moving average line, right? So what this is kind of showing you is that and there's only like 10 companies that are really driving the S&P, and they don't get extra credit in the equal weighted. So the majority of the companies in the S&P 500, it's pretty weak. It's only the tech sector and these 10 companies that are really driving this. So the equal weight is down here, but the cap weighted is still moving higher. So either the companies that are driving tech are going to pull equal weight up with it, or equal weight is going to pull tech down with it, or there'll be some kind of rotation. And we actually talk about that in the newsletter this weekend. So equal weight is a pretty good one to watch. And coincidentally, it looks kind of similar to the S fund right now. But we do have a left shoulder, head, right shoulder. And if we get a breakdown below that neckline, we definitely come down and test those October lows. So definitely something to watch, equal weighted S&P. 10-year yield. So this is a big one because as yields move higher, they tend to put pressure on stocks to the downside. We got a pretty good Elliott wave count, right? This is a relative bottom here in yield. We got a 1, 2, 3, 4, and we should have a 5 move higher in yield, which means higher mortgage rates, higher credit card rates, and all that. It puts more pressure on the economy, and that's consistent with if the Fed does have to raise rates again because the economy is super strong. All the numbers that have come out in the past couple of weeks would indicate that the Fed would keep raising rates. This week we had a little pullback, and that was the pullback right there. But MACD is just about to turn positive. It's actually barely positive there, 0.002. If yields start falling and we get below this 20-week moving average line, particularly if we get below here, great. We have another move down, and this Elliott wave count is wrong. But until that happens, it looks like yields want to move higher, which is rough on the economy. The dollar, DXY, is the ticker symbol. It's a dollar index. super important for us because with respect to the I fund. So there's a lot of different ways you can look at the dollar. I debated on which charts I was going to put up, but I decided to do the longer term one, and kind of here's why. The most recent high in the dollar was back in 2001. We had a big decline in the dollar into 2009. And if you were around back then, this is where the I fund started outperforming the C fund. When the dollar declines, the I fund rockets higher. And over this time period, the I fund absolutely crushed the returns of the C and the S funds. Since then, the C and S funds have been outperforming the I fund. And so because the dollar is rising, right? When the dollar rises, the I fund goes down. And so at this point, people have kind of written off the I fund because, since the bottom here in 2008, 9, the I fund has been underperforming. And so much time has gone by that the dollar has been rising and the I fund has been falling. People are thinking that the I fund is no longer worth looking at. And at some point, we saw it here, this huge move up in the dollar. The I fund tanked, right? And then this huge move down in the dollar, the I fund recovered. And so it looks to me on this chart that the dollar wants to move higher and test these prior highs. So this would be a decline, a pretty significant decline in the I fund if that happened. You got it's kind of supported here by MACD is ticking up after being pretty oversold, and RSI, we'll see it's right at that 50 line. If it breaks higher, this is again the chart of the dollar. So if it breaks higher, the I fund goes lower. But this is a big picture chart. But it looks like we want to get back up to retest that 120 top. And then the last one is the smart money, high yield growth versus cash. So it's pretty interesting because high yield growth is in candlesticks and the S&P is in orange. Okay. So you got high yield growth rolling over. If you remember what was going on back in 2019, the economy was not in great shape. And a lot of people don't remember it because it gets overshadowed by COVID. But we were very likely due for a recession in 2019, and it just got absorbed by COVID. But high yield growth was already rolling over. We had some consolidation, right? A little bit of an uptick there, which was consistent with this rally going into the end of 2019. And then, we drew this trend line, and we broke down through that trend line right before COVID. And then this was obviously the gap down because, nobody was looking for risky assets as COVID was coming in. So basically, we had a leading indicator. The smart money was getting out. They were actually getting out back here. Got a leg down, a consolidation, and then we were beginning another leg down right here, and then we got COVID. So that pushed everything down. But we definitely got a heads up that something was going on in the market from the high yield growth versus cash index. We get to the bottom. Everything bottoms out in COVID. As you would expect, when the high yield growth is going up, the market's going up, right? Because people are buying riskier things. At some point here, they stop buying high yield growth, and the chart flattens out. And so it's not it's a very good leading indicator. This one just happened to be, right before the drop. This one, it's an anticipation of this top. So it's early. It's basically flat, right? But then once we have this correction, yield falls off. The low in high yield growth versus cash was actually June. So on the S&P, we have a June low, and then we have a final October bottom, right? But this is a good leading indicator on the upside because the high yield growth ratio was much higher. So price hit a low in June, a lower low in October, but the high yield growth to cash ratio hit its lowest point in June, which meant, so it's a divergence, right? We talk about divergences all the time. This is a really good divergence. So the smart money was already pouring back into the market in here. even though price was finally bottomed in October, smart money was pouring back into the market here, and that's what was driving the rally higher. There's also a lot of people that think the market's going to roll over, right? So we have a big move lower here in high yield growth, which was consistent with that move down, and it's basically been flat as the market has rallied here in the last couple of months. The most important takeaway from this basically is that high yield growth versus cash is a really good way to look at where, they call it smart money. It's where institutional money is flowing. And so institutional money started falling off here at the beginning of 21. And even though this is the S&P, if you looked at a chart of the NASDAQ, it peaked out right around here. The S&P didn't peak out until later, but that's why smart money was getting out, because tech had started to roll over back here in 21. Okay. It's a little bit wonky, that one, but it's a good one. Okay. Bonus chart. NASDAQ 100. Well, hold on. You get anything about all those five?
No, man, I'm just soaking it in. I'm actually sitting over here trying not to cough.
Yeah, those are the five big ones for kind of context of where we are.
Yeah, and so the way you would apply that, right, is what we do normally is have all those kind of set up in our stack of things. And right now we're using TradingView, more often. But we used to use stockcharts.com, and we've tried just about everything, and every one of them has a little bit, a little pros, little cons. But TradingView for us seems to be, kind of the cleanest and most robust. Yep. Now, with all that said, to be able to have all those saved, normally you're going to have to have some sort of paid subscription. Yep. Now, they're not expensive, right? I mean, I wouldn't call them expensive. $10, $15 a month. Some of them are going to be $25 a month or whatever. But if you're serious about this, you would pay that. And then you can have all those saved. Now, if you don't have all those saved, it really doesn't take that much time to just punch them in. Right. Let's just say you got a free account and you can only have, 2 things up at one time, whatever it is, big deal. We just talked about 5 things. And we also, one of those is already the C fund. Right. So you've got, basically 3 other things. AGG, DWCP, the I fund, the S fund, right? And the F, you would just... That's about it. And that's like a massively robust stack of tools to be able to manage your retirement account. Yep. Like if you had all those and you're really paying attention and you're learning from our podcast and everything, you're like light years ahead of the average person trying to manage. And you could literally do that once a week. Yep. Sit down, take a look at all that stuff. Everything Jerry just showed you is weekly driven. Yep. So take a look at it for the week. Say, okay, here's where I see things are going. Have a plan for the week, and just wait till the next week.
That's it. That's the best way to do it.
Honestly. Yeah, it is. It is definitely the least stressful way. Yep. The only other way is to let someone else do it.
Yeah, sure. That's less stressful.
Yeah, well, and that's what we're here. We're somewhere in between. Yeah, right. We're somewhere in between where we're showing you how to do it yourself. Or you can, let us help you kind of validate your decisions and look over our shoulder at what we do. And that's where the grow model comes in. Yep. All right, man.
All right, so NASDAQ. So AI is booming. People are talking about it being basically, I've heard it described as the on par with like the internet. I've heard other people call it on par with like electricity. Like
I think, I'm a tech nerd, right? I mean, I helped stand up an internet service provider in the late 90s in Jackson, Mississippi. I can definitely say with confidence that I was in the .com boom, right? I took a break from law enforcement to go do that for a couple of years. Hated that world because it was just so backstabbing that I came back. And I also have an undergrad in IT. So with those things said, I kind of like to think I have a qualified, answer most of the time, right? And I don't think people are wrong when they say that. I think it's revolutionary. I think it'll be but we're like in the days where we're before like dial-up modems, right? When it comes to AI.
Right.
So if you put that into perspective and think, okay, if anybody remembers what a dial-up modem was like, I mean, I can remember times when I wanted to download a picture, like a map of something, and it would take about 45 minutes to an hour and a half, right? That's what we're talking about, right? We're not even close to this stuff being just at its full potential, lets us, what we may even do with it, right?
Sure.
And so, but yeah, I would say between blockchain technology and AI, we are on the cusp of a whole nother generational shift of technology. And if anybody remembers what it was like to be alive and thinking about this stuff in like 94, 95, right? You had no concept. You knew it was a big deal, but you didn't really know. You're like, is email really worth? Is that all it's ever going to be?
Right.
Is the web pages that existed then? Is this what it's going to be? No, it's going to be so much more, right? And that's where we're headed. It's like this computer was not possible back then,
right?
And that's all this is a computer, right? It's not a phone anymore. It's a computer.
Nobody talks on that little computer anymore.
I don't talk on it. If you call me, you know that. If you're a buddy of mine, right? It's very rare that I actually talk on that thing. But that's the point. So I would agree. I think they're getting a little ahead of themselves. I think it's a lot of hype, and when you have hype, you got bubbles, and so a bubble could burst. But it's unfortunate that I think we're putting so much thought and energy into something that's so in its infant stages that we should be worried about some other things.
Yeah, no, I agree with that for sure.
I mean, it's great and all that, ChatGPT can write a book for you or whatever, but it's got a long way to go. And with that said, unless you're in the field, right? If you're in the field, then stay at it. But if you're like, the rest of us that are sitting on the sidelines doing whatever, like, I don't know how much thought I'd put into it. I mean, unless you're going to use it for something, like you're trying to start a business to do whatever. But if you're just the average person watching it on the news, I don't think you need to put a whole lot of thought into it right now.
In terms of investing, I don't know that there are a whole lot of ways to play it right now.
Yeah, I mean, you can't. I mean,
you can chase it if you want.
You can, and you could go. I mean, you'd have to be so deep in the industry to know where those are, because to invest in it, you're going to have to be private equity, right? You're going to have some serious money. Yeah. If you want to do it on the public side, you got to find a way that somebody, right now it's Microsoft, Google, it's Meta, Nvidia, all the players.
That's what I mean. Those are the ways you can get into it.
That's the way you put your money into it, and that's not all they do, though, right? So, yeah, I mean, to try to say that you want to catch that, it's a little early. We talk about this a lot, right? Where what I think of is there's these companies that are going to come along that are going to be the next Oracle, the next. Nvidia is a good example because they started off with just video cards, right, and stuff, or what's the other one that always escapes my mind? Alcatel. Alcatel was a little tiny company that made some hardware that kind of made the internet work. Right. Those companies will come along, and then you need to watch them and catch them on the uprise.
Right. It's tough. Remember Synaptic?
Yeah.
They're the company that made the Apple back in the day. If anybody remembers, there was the iPod and this little wheel thing that you scrolled like that to make your music and all that. Like this company called Synaptic made that, and they were like 10,000% higher in a year or something. Because
you'd have to be really dialed in and quite lucky to catch it. But it wouldn't be lucky to catch the Amazons. Plenty of people saw that coming.
Yeah,
you had to be paying attention to the industry.
You could, and at the same time, after the .com collapse, I think Amazon lost like 98% of its value.
Yep, and the only way you would know they're going to be the Amazon of today is not by buying stuff off their website. You would know that because they started building all the data centers. They realized that the whole world needs clouds. And so they invested so much money into that and got ahead of. I remember a guy at Microsoft telling me that when Microsoft figured it out, it was already 7 years too late. They're just like, we can't catch up,
I mean, I love talking about that stuff. But then when it comes to the chart, like everybody's like, Amazon and Apple and Microsoft, like you would have made a killing if you bought them. It depends when you bought them.
When you bought it, and you'd have to be paying attention. So you wouldn't turn your head away when they took a 98% drop. You'd just go, okay, well, first of all, you would have gotten out because you just seen that coming in the
Hopefully,
chart, hopefully, you know, but you would have kept your eye on them, and you would have been watching that historically, and you would have been like, oh, wait a minute, you know, and again, from your perspective, you wouldn't care why.
Right.
You just see it in the chart. You know, from a fundamental perspective, you could say, oh, well, this is why, and we should be ahead of you. Put those two together, and now
you have something.
Now you're ahead of it, right?
Yep. Yep.
Let's take a look at the NASDAQ.
So NASDAQ 100, okay? It's the top 100 companies in the NASDAQ. It's not the full NASDAQ composite index. So there's a NASDAQ composite index and there's a NASDAQ 100, okay? So when people talk about the triple Qs, QQQ is the ticker symbol. It's the NASDAQ 100. So this is something that's pretty interesting. So here's the top, like I said, NASDAQ actually peaked in 2021 before the S&P 500 peaked at the beginning of 22. Had a pretty big, similar to the S&P, but a big move down, right? 1, 2, 3, 4, 5 into that October low. And then we had this ABC correction, just like we did in the C fund. And then we had this explosive move higher in the NASDAQ. So NASDAQ hit this 61.8 retracement level last week, and this week it's going to close above it. So a lot of people were looking at this level to provide some resistance, and we didn't get it. So the next target is the 786 level up here. So it's entirely possible that the NASDAQ keeps moving higher, and those companies, I mean, this is NVIDIA, Apple, Meta, Microsoft, that's what's doing this. And it can keep pulling the C fund higher. And the fact that it got past that 61.8 retracement level is a pretty big deal. It's likely to keep moving higher. And the next major resistance level is up there at, 375. But getting above that 61.8 retracement level is a big deal. And you can kind of see the difference. So this looks the same as the S&P. This looks the same as the S&P. And then once we had this move down into March, it has just exploded, and that's the AI. That's the AI boom that we're seeing right now. And it's only been a couple of months long on the chart. It's been a lot longer in the development of it. But, we get some kind of pullback in the NASDAQ and then probably a big move higher. I mean, it's probably not going anywhere in terms of the chart. In terms of the macroeconomic stuff in the world, it's everything is lining up for the market to go lower. It's unbelievable. Okay, TSP fund charts. So I got a couple of really technical kind of things to look at right here. So if we just look at these horizontal lines for now. So this is the weekly chart of the C fund. We got roughly 4,200 here and roughly 4,300 here. Okay. You got support, a big gap down, resistance, overshoot there, resistance, and then all this resistance here. And then this week we're finally, it looks like, going to actually break into that zone. So that's the first piece. We get into this resistance zone anywhere in here, the market can roll over. If we can get up and above that 4321, call it 4,300-ish. If we get up here somewhere, it's very likely that the market goes higher. And there's one scenario is that we're going to have a melt up. And if we got above 4,300, I would expect to see a melt up. I've seen estimates up into the 6,000, 7,000 for the S&P 500 by the end of the year. It's possible. It's not consistent with any of the macroeconomic stuff, but it's possible. So this resistance zone is really important, and now we got above the lower resistance zone, so now we're right in it. And it'll be really interesting to see what happens when we get to that 4321 level. S fund, not doing as well, right? So we're actually recording this on Friday morning, and full disclosure, by the end of, while we're doing it right now, the S fund gapped up today. So it's entirely possible that this support holds. And if we can get above 1,700 on the S fund, that's awesome. And then the next resistance level is up here, and then we're off to the races. So this idea of rotation that we're going to talk about in the newsletter, it's possible that tech can pull back, but the other 10 sectors in the S&P 500 start to catch back up because they are all pretty oversold. So while tech has been moving higher, everything else has been moving lower. The thing that's interesting is the S fund is more tech than anything else, but it's not the mega cap tech. So the other stuff really hasn't been performing very well, and we've been below that 20-week moving average line now for a few months. If we can get up here and the technical indicators start moving higher, we could be in good shape on the S fund. And it's actually got more room to run at this point than the C fund does. So it could be a better opportunity in the S fund than the C fund if we can establish that we definitely got support at that neckline. I fund, we got huge buy trigger back here in the I fund, right? Obviously, we got above that 20-week moving average line. RSI above 50, MACD had already crossed positive. Big move up in the I fund, and it's consistent with the dollar falling, right? I fund pulls back, gets below the 20-week RSI, got right down to that 50 line, and MACD was right at 0. So it would have been tricky. You would, you could have gone either way, whether you want to call that a sell trigger. But then the market recovered the next week and kept on moving higher. So it's entirely possible. This would have been a rough call right here, but other than that, that buy trigger has been in place ever since the beginning of November of last year. Right now, this week, it looked like if we had closed at the bottom down here of the trading range, it would have probably been a sell trigger. We have a negative MACD. RSI hasn't gotten below 50 yet, but if price had stayed down here, it probably would have been. But that's not what happened, and that's why you have to wait until the thing completes. So we intra week, we got below that line, but again, the market's up big today, so we're going to be up here somewhere at the close of the week. So everything is still in place. It's hard to watch the market on a day-to-day basis. If you're trading on a weekly chart and you're watching on the market daily, it's got to be excruciating. So again, have a methodology and stick with it. F fund hasn't been, there's not a whole lot to say about it, right? We've been talking about the same thing for a long time. We had a peak up here. We got a 1, 2, 3, 4, and I'm looking for another leg down on the F fund, which when price goes down, it's because yield goes up. And like we talked about on the 10-year yield chart, we're looking for a leg higher in yield, which would be the same as a leg down in the F fund. This week, we had 2 solid down weeks. We're still below that 20-week moving average line, but we had a recovery this week. And we also had a recovery in stocks. So it'll be interesting. We haven't gotten too oversold in RSI. So as long as RSI doesn't get really below this low, it's possible that it keeps moving higher. But we'll have to see. The bottom line is we're in this channel, and we could easily just be, we hit the bottom of it, come back up, hit the top of it, and come back down. So we'll have to see. Nothing's really in stone until we get above this high or below that low. All right.
Questions?
That is all I got. I feel like that was a little bit disjointed. It was a lot better in my head when I was putting it together than I think I presented it. But hopefully,
Well, it was down and dirty. I mean, we went through it pretty quick. But I tell you, it's shows like this that we do that seem pretty simple that I think sometimes are like some of the most valuable because, in the last 35 minutes or so, we literally gave you everything you needed to know, right? Not everything, because there are things we talk about every week that kind of build on it. But I mean, at the end of the day, build your charts out for the funds, right? For the CS and I and F, and the 5 that Jerry showed you, one of those you already got with the C fund, and you just got a lot of tools there, right? Yep. And then listen to this every week for the kind of wrap up there at the end for the TSP charts.
Yep.
Man, like you got,
you're in pretty good shape. You have to practice.
Yeah, you do. You can't be passive.
Yeah.
You can't just kind of glaze over and it won't work. But that's okay. I mean, there are plenty of you out there, I think, are getting into this, and I think we're onto something. We feel like we are. Or hopefully we're giving you guys something that you need. If you have questions, you can always put them in the comment section wherever you found the video, whether it's Facebook, YouTube, wherever. Also, if there is not a comment section, you can shoot us an email at support@growmytsp.com. And if you like this, please share it with your friends.
Please do.
But if you don't, share it with your friends anyway. Hope you guys have a great week. Jerry's going to be out for about a week or so, traveling out to sunny California.
San Diego.
And, we'll see how the show goes next week. It may be just Jerry. We'll see what he does on the road.
Yeah, I might be doing it on the road. I got some ideas of what I want to do next week. So
he's going to be sitting on a beach somewhere with a video camera going, na na boo boo. All right, guys, you have a great week, and we will see you soon.
Out of here.